distinguished participants, dear colleagues, Assalamu alaikum wa rahmatullahi wa barakatuh. It gives us a tremendous pleasure today to welcome you to this public hearing session on the exposure draft of the AAOIFI Financial Accounting Standard, Financial Reporting for Institutions Operating in Hyperinflationary Economies. This event is held in collaboration with Public Oversight Accounting and Auditing Standards Authority, KGK, in Turkey. We would like to thank them for taking the efforts and extending their support in organizing today's public hearing. The public hearing is one of multiple steps in a standards development process at AAOIFI and represent an opportunity for us to interact with and benefit from the knowledge, experience, and wisdom of professional individuals and experts from all corners of the industry on the newly issued exposure draft. This public hearing is the first public hearing for this exposure draft this year. This standard outlines the principles governing financial reporting, including accounting treatments, presentation of financial statements, and necessary disclosures for institutions applying AAOIFI financial accounting standard, operating within hyperinflationary economy. It was developed taking into account the applicable Shariah principles and rules, as well as the unique business models of the institutions, while stipulating appropriate principles of financial reporting. Now, and without further ado, let me invite to the virtual floor the Secretary General of AAOIFI, Mr. Omar Mustafa Ansari, who will present the exposure draft and walk you through its main content, while answering time to time your questions in an interactive session. Brother Omar, the floor is yours.
Thank you very much, Sister Hora. A'udhu billahi minash shaitanir rajeem. Bismillahir rahmanir rahim. Rabbi shrah li sadri wa yassir li amri wa hlul 'uqdatam min lisani yafqahu qawli. Ladies and gentlemen, assalamu alaikum wa rahmatullahi wa barakatuh. First, I would like to pass on the congratulations and blessings for this holy month, and I hope that all of you must be enjoying the maximum of the benefits and the maximum of the blessings of this month. And I'm also thankful to all of you who are present here today. We understand that because of being Ramadan and some of the regions at the time colliding with the iftar time, and in some regions it's colliding with the time for prayers. And for those who are attending, actually I can thank them for actually they are actually sacrificing their afternoon nap Kailula against this public hearing session. So a special thanks to all of you, and I hope and I pray to Allah Almighty that this session becomes fruitful for all of us in terms of learning and in terms of whatever progress AAOIFI is making with regard to these standards on financial accounting and obviously other standards. First, I would like to just take you through some background points before taking you through the standard itself. One thing that we should consider that this is one of the most technically difficult standards that we have worked on. And it's not only about us. Even if you talk to people at ISP, I'm not talking about only the normal experts in IFRS. I'm talking about even people at ISP and some of their technical team members and some of their even board members. They believe that this standard is very difficult, very complicated, even the IFRS, that is 29, that is very, very complicated, and its practical application becomes more complicated. Now, just I would say that multiply those complications with the 3 or 4, considering the additional Sharia-related challenges, the additional business model-related challenges, etc., that we have in case of Islamic finance. So from that perspective, it had been a huge challenge for us to work on this standard. Last year, we developed this standards exposure draft on a fast track, And the idea was to to push it hard to be closed as soon as possible. But at the accounting board of AOFI, we thought that pushing it very fast on finalization track might not do enough justice with this very significant standard, because it might need more time of thinking, more time of discussing, more time of sort of how to put it. I would like to put it the way that this need, some sort of uh, cool down thought process, that you don't just try to finalize the thing in one go or in one sequence. Rather, you give it some time, you give it some space that you can think about it. Why I'm putting this question, about this thing, this need, and this question that I'm putting. You will find the answer to this why in our discussions that we are going to have, because it's so complicated and some of the angles are so complicated, even within FARS, that their application becomes more and more difficult, particularly for Islamic finance. The first question that we ask every time ourselves with regard to any of the accounting standards that we develop, that what is the need for this accounting standard? Is there any real genuine value addition that we are going to make? Like, for example, if I say that, if I just put it this way, that is this standard just for the sake of making a standard, or is it genuinely going to do some service to the industry, which is otherwise either a gap or which is otherwise in form of a wrong or incorrect treatment? So what happens that whenever we work on any project, we evaluate as to whether there is any specific Sharia issue with regard to certain transactions or products which actually need this issue of Sharia compliance to be addressed in accounting. The second question is about the business model and the transaction structures, that even if conventional standards are available in this area, is there anything that they are missing out with regard to the transaction structure of Islamic finance? Or if if they are applied without proper modification to Islamic finance, it may not be reflecting the correct tone of the or the structure of the transaction in the right manner, and hence maybe it may result in a Sharia non-compliance, or it may result in a treatment which might not be suited for that specific business model or that specific transaction structure. When we ask this question ourselves with regard to development of this standard, we actually felt that there are multiple Sharia-related challenges, and there are multiple business model-related challenges that need to be addressed. You cannot just simply apply IAS 29 directly on these transactions or on these entities which are operating in these hyperinflationary situations, because of those Sharia issues and those business challenges, business model related challenges. I'm a bit, I'm just a bit confused where to take you through those issues. Maybe I should put some of the questions initially, and then we can go through the whole of the standard, and then we can identify exactly where are the areas where we kept differences from IFRS. However, just for your benefit, I would like to mention that we identified those 4 questions earlier, even before development of the exposure draft, and while we were in the stage of preliminary study, we conducted multiple discussions. Particularly, we involved the industry as well and held focus group roundtable on that as well to discuss some of the key questions. The most important key questions, some of them even are discussed. I can tell you, that as we collaborate with the International Accounting Standard Board's Islamic Finance Consultative Group as well, even in their meetings, some of the challenges have been discussed. I won't say that there were no clear conclusions to some of those issues, but those challenges were at least discussed there. This issue of hyperinflation has become very, very relevant in the post-COVID scenario. So when we started evaluating that there are now more and more countries which are now either subject to hyperinflation accounting officially under IS, they might be applying even if they are not officially applying it. But there is a longer list probably which is subject to these challenges. And obviously it is evident from the highest interest rates hikes that you can see in different parts of the world that the benchmark rates and the government discount rates are significantly high as compared to the pre-COVID times or during the COVID times, which gives you a very clear indication that a large number of markets are impacted or are at a risk of being impacted. Some of them are on verge of it. Some are actually into it. Some are some are actually subject to the criteria, but the governments, the respective governments or the central banks haven't concluded on them being hyperinflationary, so they are still not following. But the additional challenge come at times when the parent is following IFRS and the subsidiary is in a country where there is hyperinflation, and the situation comes in a way that the subsidiary might not be applying hyperinflationary accounting in its local financial statements because of the local central bank or local government or the local accounting authorities not adopting the IAS 29 or not declaring the country as hyperinflation economy, but still they might need to do it for the consolidation purposes. And that was the reason that we started receiving many queries from some of our members, some of our accounting board members, our board of trustee members, some of the central banks to whom we were talking. They all started asking about what is the OFI's stance on this. Maybe I'm taking a bit of time in this background, but it is very important to understand this whole background before we go to the standard itself. So my apologies for taking your time on this. I think I can see a question in the Q&A tab. Okay, there is the brother Al-Tijani Ahmed. Assalamu alaikum, wa alaikum assalam, and Ramadan Kareem. Thank you very much, brother, for being with us. Now, when we started working on it, the main challenges were, number one, whether Sharia accepts a value for accounting purposes different than the actual value at which the transaction has been executed, particularly where a receivable or payable is involved. So this is just one of the most challenging questions, that if there is a receivable or payable, any increase in that receivable or payable is not acceptable as per Sharia. And the challenge comes because the increases and decreases that come there might have to impact in the process. They impact the balance sheet as well as the income statement, which means that the profits that you are calculating and eventually that you are distributing to your shareholders and more significantly to the investment account holders and other participatory stakeholders, they are adjusted profits. So the first question from the Sharia side was whether any type of this treatment is acceptable at all. The second question, I'm not going for all the details, but I'm just going to put some of the questions in front of you to give you an idea about how diversified those challenges were and how significant their impact was and how difficult it was to find some possible solutions. So the second example is that if there are reserves, gains and losses and reserves which are there, those reserves should not be should not be related to the shareholders alone. But the way accounting is done normally in case of hyperinflation, the effects of hyperinflation are not passed on to the investment account holders or other participatory account holders, even participatory investors like Sukuk or others. So the unique business model of Islamic finance transactions and structures actually put some sort of difficulty in recognition of those gains and losses, or what is the net monetary position difference. How that net monetary position difference is to be accounted for. That is a huge challenge, not an easy question. Not only this, let me put another question. The question is, if there are profits and loss distributions done on a monthly basis, is it possible as per Sharia that after the profit and loss distribution is done on a monthly or quarterly basis, is it possible as per Sharia or is allowable as per Sharia that you go back and adjust those values because there was a constructive liquidation that happened at that point of time? While in hyperinflation accounting, you need to adjust these balances on monthly basis. So are you going to adjust the profits distributed or not? And if you are not going to adjust the profits distributed, but you are going to adjust the values of the transactions, where does the difference go? Just try to think of these sort of questions, and I'm telling you that the list of these questions is a bit longer. And not only this, and then if you try to find a solution, there can be other issues with regard to some of the challenges. So for example, if you say that if you want to do these adjustments, the question may come with regard to some held for maturity transactions in this, either sukuk or other transactions where there is a profit and loss distribution, a profit and deferred profit which is attributed over a period of time, and there is a distribution for that. If these values are adjusted, what will happen? At times, some of the my apologies. There was a message on the screen which I had to remove, so my apologies for the disturbance. So, with regard to those values that are determined, if those are revalued and if those are adjusted according to the new values, what will happen? That there might be loss issues on that, particularly if those are fair value. And considering the higher interest rates and the benchmark rates in the current times as compared to 3 to 4 years back, when most of these investments were made, particularly the long-term investments, those were made at the lower rates. We have seen the failure of Silicon Valley Bank and certain other banks recently because of the same issue, that their investments were in mostly low rate fixed return investments, bonds, etc. And any institution that has made investments like this is in huge difficulty in this point of time. So it is another challenge that we need to consider, that while we can try to find solutions, but some of those solutions may not be workable for all type of Islamic financial institutions and all type of instruments that are there. And if you feel that this is a better treatment, it may still result in a huge a challenge on the regulatory capital, huge challenge on the losses that are to be recognized today, things like that. So again, I'm sorry I have taken a lot of time on this issue. Still, some of you might not be fully able to comprehend the challenges that I'm discussing, because some of the background debate might not be present to you. But I can understand that those who have been applying the IAS 29 or have read IAS 29 and other challenges that are there right now, they might be able to comprehend some of the challenges that I have mentioned. So at this point, I would stop, and I would like to take you through the document itself. And as I always say, I mention that the presentation is exactly the same as the standard. So normally we do not share the presentation in this form, but the PDF version is already available. And I'm sure that some colleagues might have put in the chat window already a link to the standard. But if it is not put, then may I request you, sisters, to please put a link to the a PDF of the exposure draft in the chat window. I can see a comment in the Q&A tab. Okay, sorry, that's the same one. So I didn't forget to close. Today, I'm afraid that I'm the only one speaking. Why? Because number one, it's too complicated standard and not at all very suitable to be discussed in a Ramadan afternoon when everybody would be like, missing a nap and would try to take a nap in between. And the discussion would be so boring. I can tell you, again, it may be interesting for us, for some of us, but for some of us, it might become so much boring that, I'm afraid that the input from the audience today will be less. So today I'm specifically requesting all of you to be a bit more active, try to put some questions and comments that are in your mind on the standard. And particularly, I would like to mention that for this standard, that's what we have done in this standard, the accounting board wants very proper industry input in that. Because we have done a small sort of experiment that we try to, how I would put it, we try to have some out of the box thinking this time. Means that we have not followed, normally what we do, we try to create a bridge between IFRS and Islamic finance transactions, trying to be as close as possible to IFRS. But in this standard, we have deviated from IFRS significantly. We have tried to bring closer to some extent, but we have not tried to just make a bridge between Islamic finance and IFRS. Rather, we have tried to develop a standard of our own, which may have some concepts borrowed from IFRS, but its main treatment and main approach is not just adaptation of IFRS. Rather, it's a new sort of accounting approach in some of the areas in particular. And that is the reason that the board wanted to have more and more industry input on this standard. One unfortunate thing, I know that even some of you might be willing to contribute and might be interested in the topic, but because of the lack of practical expertise, because this standard has very much limited practical application as of now. Not too many Muslim countries are within the paradigm of hyperinflation. I think Turkey is, Syria, Lebanon, Pakistan just close to it. But even there are countries where we have where Islamic finance is not enough, but you will still find some institutions. But the countries which are at the margin of or at the risk of hyperinflation include a lot of Muslim countries in Asia and Africa, and they include some of the even non-Muslim countries in the regions, and some of them having Islamic financial institutions existing in those. So this may be a bit of unfortunate that a lot of you might be willing to and willing to and eager to contribute to this standard, but may not be able to because of these limitations of the practical experience and the applicability in your countries. Brother Tijani Ahmad has a comment. Any unjust financial dealing is not acceptable from Sharia. I refer to Umar Chhabra Tijani. Brother Tijani Ahmad, thank you very much. Generally, yes, your comment is understandable and agreed. But the question is, where are we trying to apply this analogy? Please let me know. because in this standard, we try to keep things as fair and just as possible and try to allocate the respective gains, losses, and accounting differences to the respective parties to whom they belong. So from our perspective, we try to keep everything just, but if you have any specific aspect, please let me know, sir. Brother Imran Arshad has a comment which is incomplete. So, Brother Imran, please, if you can kindly complete your comment. Brother Yasir Saleh Ali Al Munifi has Walaikum Salam Ramzan Kareem. Thank you, brother. Brother Imran Arshad, your comment is incomplete. I don't know what is the reason. Can you kindly try to complete your comment? Okay, with that, I move to the sharing of the presentation. I hope, and I hope you all can see the screen. Okay. I have covered most of the parts related to introduction and preface, as I normally do in initial introduction, so that is covered. Let's start from the objective. The objective of this standard is to establish the principles of financial reporting for the institutions applying AAOIFI financial accounting standards as is operating in hyperinflationary economies, duly considering the relevant Sharia principles and rules and their unique business models. Now, scope is important. The standard is applicable to the institutions preparing financial statements in line with the requirements of AAOIFI phases whose functional currency is the currency of hyperinflationary economy. This standard shall also be applicable on consolidated financial statements of an institution to the extent of impacts relating to a subsidiary whose functional currency is the currency of a hyperinflationary economy. Now, unlike certain other standards, here the scope is expanded, even including a definition. Why? Because what is hyperinflationary economy is the subject of determination of the scope, but not the subject of accounting itself. So actually, you need to first determine what is a hyperinflationary economy for the purpose of determining the scope of the standard. And that is which institutions have to follow this. So from that perspective, this definition of hyperinflationary economy and the criteria are here. Even in IFRS, it is here, although it is not defined the way we have defined. So our definition is probably more comprehensive. IFRS has mostly talked about the criteria. A hyperinflationary economy is an economy wherein money normally denoted in terms of the currency of that economy loses purchasing power against assets, goods, and services at such a rate that impedes the meaningful comparison of financial reporting in respect of transactions and events that have occurred at different times, sometimes within the same financial reporting period. Now, how to determine this hyperinflationary economy? So the main crux of the definition is, if you allow me to repeat that part, is it loses purchasing power at such a rate that impedes the meaningful comparison of financial reporting. Now, the question is, are we comparing with the transaction that happened today with the transaction that happened yesterday or that happened last month, or we are comparing against the transaction that happened last year or year before that? Hyperinflation accounting addresses both challenges. That is, even during the current financial period, it needs adjustment. If the impacts are material, it has an adjustment element since the beginning of the year or beginning of the financial reporting period till the date of reporting. On the other hand, the comparison, that is the corresponding figures, are also important to understand the performance of an entity over a period of time, that is period to period comparison. We had challenges on both ends. First is that how to account for anything that happened in the beginning of the month or the beginning of the last month or beginning of the current year as compared to the transaction happening at the end of the year, or the balances that are reported at the end of the year in the balance sheet. And the other challenge was also there with regard to the corresponding figures being adjusted with regard to the last year or the year since beginning of the because you have to adjust it on a historic basis. So this comparison within the period and the comparison with the comparative period both remained a huge challenge. And we had a question with regard as to whether and to what extent we can apply the same accounting approach to both of them. But we had more challenges as compared to simple application of IFRS. In the simple application of IFRS, you can have indexation of the comparatives easily, and for the whole year, you can have indexation, index-based adjustments. But for the transactions where you have already, most of the transactions are part of the investment pool, where the profit and loss distribution is done before the end of the period, that is on each month end. So now today I am standing at the end of the year, but I have already closed 11 periods of the profit and loss distribution in my year, and I have closed distributed the profits and everything. The constructive liquidation has been done. Can I go and challenge and change that constructive liquidation? Even if there are changes in the value, the monetary changes, the net monetary position difference that comes as a net position, can I put it only in hand of for the shareholders? If I cannot put it all for shareholders, can I ask the investment account holders in case of a negative situation? Can I ask the investment account holders to adjust the figures? Or can I give them additional profits or take profits back from them, whatever the situation comes according to indexation? If the profits are distributed to investment account holders, as per Sharia, those are constructively liquidated, so hence those are full and final. But if I go and adjust those period balances and profit and loss for those periods by this indexation and adjustments, what happens that there is a profit and loss element that comes out of it, which as per Sharia belongs to them and not to the shareholders. But in the simple application of IFRS, these all differences will go to the shareholders alone. Whatever I'm mentioning, these are the challenges that actually, in some limited examples, which we were able to review, we actually found that these are the very relevant examples and very relevant issues. So from that perspective, it is very important to understand that this is the crux, that meaningful comparison should be there. This is the challenge. How you bring in that meaningful comparison might not exactly be appropriate through a indexation in all situations, and particularly indexation and adjustment of receivables and payables, which are already established receivables and payables, and in monetary terms, as per Sharia, their adjustment is not allowed. As per IFRS, the current balances for monetary balances are not adjusted, but all the comparatives are adjusted, which again become a challenge for us. I'm just hoping and I'm praying that I don't make things too much complicated for you. But every now and then there will be more complications coming in. And I recall one of our good friends, every time he used to say that for the sake of making things more complicated, let's discuss this. Or let's make the things more complicated by discussing this. So probably every now and then you will be finding something that I will be mentioning that will complicate it further. Now, these are the pertinent factors or the criteria for determination of a hyperinflationary economy. It is more or less similar to IFRS with some minor changes. Determination of a hyperinflationary economy in line with the definition. We are still in the scope. Let me be clear. It is not the main standard. These things do not apply within the standard. These apply before determining as to whether this standard should be applied to this entity or not. So this is all part of a scope. Determination of a hyperinflationary economy in line with the definition provided in paragraph 4 is highly subjective and hence cannot be performed by applying a fixed or predetermined criteria. Nevertheless, any or a combination of the following factors may lead to a conclusion that an economy is hyperinflationary. Cumulative inflation rate over a 3-year period has exceeded 100% or is approaching the same with an increasing trend. This is as per IFRS, very close to IFRS. In IFRS, this is the last criteria, but most of the time, this is the only criteria that is applied. I can tell you that all other criteria might be prevalent and very subjective. So this 100% cumulative index over a 3-year period is the one that is considered. And again, nobody can ask today that why not 100% every year or not, why not 100% over a 4-year period or a 2-year period. It is something that has been established. Again, we believe that it's a reasonable basis that over a period of 3 years you reach 100%. But some people will say that 33% a year or 100 less than 33% because it's a cumulative effect. So it was like 25% cumulative will come like more than this, more than 33%. So in a nutshell, without going into nitty-gritties of the calculation part, this is the most common criteria. But what change we have here is 100%. IFRS is more like approximating, but we have used the term or is approaching the same with an increasing trend. So if it has reached 100, that's okay. But if it is approaching the same, like for example, it's reaching 88, 98, 99%. So it should not be applied like, in a way that, okay, if you are 99%, then you are not hyperinflationary, and by 1% increase by 100%, you become hyperinflationary. Rather, we kept the criteria slightly improved in a way that we said that approaching the same with an increasing trend. So if you are reaching 99% with an increasing trend, it means you are hyperinflation. And if you reach 99 or 98%, but with a decreasing trend, then you will have to wait till the time you actually become 100%, or there is a more chance that next year you will not be 100% because it is already a decreasing trend. So next year, it is more probable that you will not reach 100%. And if you are in an increasing trend, there is all probability that next year you will be 100% or more. So considering these things, we have slightly amended this criteria. Now, other criteria are benchmark discount rates, wages, and prices are linked to an index. Prevalent use of a stable foreign currency in place of functional currency. Now, I would like to request all of you to keep this one in mind. Prevalent use of stable foreign currency in place of functional currency. So a lot of people doing the transactions in those countries actually will be doing transactions in maybe US dollar or euro or any other stable currency as compared to their own country currency. But this you need to keep in mind because the solutions that we have identified has one important link to this one. The prices are usually quoted in a stable foreign currency. So even the supermarkets and the consultants and the service providers and the common commodity markets, they all will be quoting the prices in a stable foreign currency, mostly US dollar, euro, or something like this. General population prefers to convert key monetary assets to or in a stable foreign currency. This is another challenge that as soon as you have your local currency in hand, you try to get it converted into the foreign currency. Notwithstanding the factors enumerated in paragraph 5, an economy may be declared to be hyperinflationary by a multilateral institution or the respective central bank or the respective government. So we are not saying that every institution to decide this thing, but With or without these conditions, the authority should be in form of a multilateral institution like IMF, World Bank, etc. That if they decide, or the respective central bank decides, or the respective government decides. IMF actually keeps an eye on the hyperinflation and has this data. IMF, World Bank both keep an eye on that and have this data. We have comment from brother Dr. Idris, Mohammed Idris. You are moving right, no complications yet. Thank you very much, brother Dr. Idris. And we would be looking forward to have your comments on actually the practicality and other aspects of the solutions that we have come up with. Sister Amal Al-Masri, Assalamu alaikum and welcome. Are there any other standards that we need to return to except phase 1 regarding determination of fractional currency, paragraph 9? Excellent point, Sister Amal, but just allow me to reach there. Then we have Brother Yusuf Al-Lazim Juma, Ramzan Mubarak, Ramzan Mubarak, Ramzan Kareem, brother. Thank you very much for being with us. Sister Amal, I'm keeping your question open. I'll just try to answer it when we reach this paragraph 9. And we would try to learn from your experiences and the challenges that you are having also, because we can well understand that in Syria, although officially it is not determined as hyperinflation, but technically it is hyperinflation. So there are huge challenges. So maybe some of the important comments you can provide as you have been providing earlier to us. Now coming to definitions. For the purpose of interpreting and applying this standard, the following short definitions are relevant. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. If I put a full stop here, this is the standard definition as per IFRS and as per AAOIFI. Obviously, our earlier standards had very slightly different definition, but that was wording or cosmetic difference. Now we are trying to align it. And IFRS also time to earlier you use a bit slightly different definition also, if I remember correctly. And they also have now aligned all of them to one. But here we are talking about another part also. And in the specific context of this standard and for the purpose of application of paragraph 15 to 17 also includes deemed fair value as prescribed in this standard. So we are saying that it is fair value, but there is a context of deemed fair value in the specific context of this standard. And the idea, I'll come to answering this question, why we are talking about deemed fair value, what is the reason and rationale for that. Hyperinflationary economy is already defined in the scope, so we just refer to it here. Index is the means of quantifying the periodic effect of weighted aggregate price, purchasing power, and of performance of economic resources. In the specific context of this standard, it is a means of quantifying the periodic effect of weighted aggregate loss of purchasing power of a currency against economic resources or against a basket of stable foreign currency, against stable foreign currency or a basket of stable foreign currencies. Investment pool is a virtual entity, at times a separate reporting entity comprising of distinct assets whose risk and reward wholly or proportionality are attributable to the funding provided by the respective quasi-equity investors. Brother Majd and Sister Sarah, just make a note of it. We just need to make sure that this wording matches with the final version, because the investment account standard is now final. Measuring units are the units of currency having a currently prevalent value at the end of the financial reporting period, or as indexed at a given point of time in line with the requirements of this standard. Monetary assets in the specific context of the standard are assets that are in form of either cash, contractual right to receive cash or another monetary asset from another institution or entity, or contractual right to exchange a monetary asset with another institution or entity. Monetary liabilities in the specific context of this standard are the liabilities expected to be settled in determinable fixed amounts of money. Now, are there any comments? Brother Yusuf Al-Lazim Jama has a question. From what I understood, that these standards are applicable only to hyperinflationary economy. Thus, those companies operating in more than one economy, where some countries experience hyperinflation while some do not have, we have not to adopt these standards. Brother Yusuf, partially your question is correct. Your conclusion is partially correct and partially not in line with this standard. This standard says, for example, let's take an example. I'm just giving you a hypothetical example. We have Al Baraka Islamic Bank headquarter, Al Baraka Banking Group headquarter in Bahrain. Bahrain is not hyperinflation. Al Baraka has its subsidiaries in Syria and Sudan and Turkey. All the three are technically hyperinflation, even if they are not following, all of them might not be following the hyperinflation accounting, but technically they are hyperinflation. So the question is, if Al Baraka follow AAOIFI standards, what would it do? Or if Al Baraka follows IFRS, what would it do? In that situation, Al Baraka may have 17 entities, I believe, out of which maybe two more might be just reaching the level. For example, Pakistan might be just reaching the level of hyperinflation, but it's still not. So if you calculate based on that, it would be more like that Al Baraka need to apply in 3 countries the hyperinflation accounting. If those countries' local regulators are not asking to follow the IFRS or AAOIFI hyperinflation accounting, in that situation, they will be doing local accounts as per local, but for the foreign reporting purposes, they will have to do for consolidation purposes and to the parent subsidiary to parent reporting purposes, they will have to prepare financial statement based on hyperinflation. Because Al Baraka adopts either AAOIFI or IFRS. This means that while one bank itself might not be subject to hyperinflation, but its subsidiaries may be. But if one subsidiary or 2 subsidiaries or 3 subsidiaries are following, it does not mean that the whole banking group or the whole of the other institutions might also be required to follow it. So this is just one example, and naming an institution was just for the purpose of giving an example, because actually Al Baraka is probably the largest spread Islamic banking group around the globe. Maybe it's not the largest Islamic bank, but in terms of the diversification in terms of geography, it is probably the largest. So from that perspective, most of the time it provides some good examples. So from that perspective, Brother Yusuf, what I would say that Al Baraka Banking Group will have to apply the accounting for 3 subsidiaries. The 3 subsidiaries will have to follow it, while other 11, 12 subsidiaries will not have to follow it. Brother Yusuf has another question that I'm also interested to know if there is any other effort made by you on the area of IFRS 17 in relation to the accounting for Islamic companies. You are talking about, I believe, Islamic insurance companies, brother. Brother Yusuf, I think that you should be how to put it? I would say that you should be referring to FAS 42 and 43. 42 is our basic accounting for takaful that is Islamic insurance companies, while the 43 standard 43 is our alternative to IFRS 17. So the IFRS 17 accounting with regard to the insurance, you need to check for it. Brother Majd, I can see you are putting an answer to Sister Amal's question. I kept it open for purpose, so please do not close that question. When we reach that paragraph 9, please remind me, I will answer that.
Yes, sure.
There is an anonymous attendee. Assalamu alaikum wa rahmatullahi wa barakatuh, Ramadan Mubarak. But since you are anonymous, I don't know brother or sister, so anyway, wa alaikum assalam and Ramadan Mubarak. to you and to all of you, but I would always request everybody to please rename yourselves from Zoom. You get this option of renaming yourself, or when you log in, you put your names, because all the comments that you provide, we have to take those comments to the working group and to the board. So from that perspective, it is important that we know the name for all of your names. Even it would be better if you can put your name with your institution name. So this gives us a better understanding of the context in which the comment is coming to us. Thank you very much again, everybody. Now let's try to move on. Now, coming to financial reporting by institutions that are operating in hyperinflationary economy. So what solution we have tried to find? We have found two solutions, two possible solutions. Again, this is the exposure draft. So these are the proposed solutions. And this is where we request all of you to provide your very categorical comments, trying to apply them, try to understand them better. And if you feel any further issues that we need to address, please let us know. So first option is that we should be following either of these two. One is you do functional currency redetermination, and two is that you do fair value based accounting. Now, why these two options are there, and why not just index based solution is there? I raised some of the questions in the beginning. We believe that as per Sharia, doing accounting in a different currency is perfectly acceptable if it is a functional currency of the institution. So even according to Sharia, there are rules about currency of shirka and all that you need to determine, and then reporting currency has to reflect those balances according to the respective accounting policy. So this functional currency redetermination and doing accounting in a different currency is acceptable as per Sharia. This is acceptable as per our earlier standards, and obviously these all issues we have discussed with the Sharia committee as well. The second issue is with regard to the fair value. The second possible solution is with regard to the fair value based financial reporting. So according to Sharia, it is preferred to do all profit and loss distributions and accounting on fair value basis, because as per Sharia, the most appropriate way of profit distribution between investment account, between shareholders and everybody is through actual liquidation. But since actual liquidation takes time, so Sharia allows constructive liquidation, which means that you need to perform periodic accounting based calculations, and based on that you distribute profits, and you close that venture to that date, and you start on the next day a new venture. So in that situation, the earlier amounts are constructively liquidated, which means they are settled. You are if there is a issue with the settlement, you will not go to the investment account holders home and ask them that, okay, you need to give me back some profit that I paid you earlier. No, it is constructive liquidation. It's fully and finally settled. But as per Sharia, for constructive liquidation, it is always preferred to have fair value accounting. Even for Sharika particularly, and Mudarba and other types of participatory investments, Sharia always prefers fair value accounting, because fair value accounting provides the most just and fair basis for the profit and loss distribution between the investment account holders and the shareholders and other participatory account holders, whoever are involved in that transaction. So the fair value accounting is acceptable as per Sharia. So what we are saying is that if you are in hyperinflation, either redetermine your functional currency or do the fair value accounting. See paragraph 9 and paragraph 10. So let's first go to paragraph 9. Where a factor or a combination of factors thereof as enumerated in paragraph 5C, 5D and or 5E exist. Now, this is what I was asking you to keep in mind. Okay, let me take you back to 5C, 5D and 5E. If you see 5C, Prevalent use of a stable foreign currency in place of functional currency. Prices are usually quoted in a stable foreign currency. And general population prefers to convert key monetary assets to in a stable foreign currency. If these three conditions exist, which are the condition of hyperinflation economy, these are also the conditions that might need to think again, what is your functional currency? What is your actual functional currency? Now, please keep in mind that reporting currency can be different from the functional currency. And while we know that some regulators or most of the regulators might be requiring the institutions within their country to use the local currency as the reporting currency, but still if the regulator allows, then redetermination of functional currency might be a very good solution to decide with regard to how to apply the hyperinflationary accounting. And I can tell you that redetermination of functional currency, which has certain common factors with the hyperinflationary economy determination, may result in a situation that you have a I would say, more appropriate and more faithful accounting. Faithful representation, that is the term. For me, for some of the regulators, if they allow accounting in a foreign currency being a functional currency, which effectively is the currency in some of those countries, it should be considered as a proper way of applying the hyperinflation accounting as compared to what we do in the in the case of a normal application of IS-29. So where a factor or combination of factor thereof as enumerated in, or a combination thereof as enumerated in paragraph 5C, 5D and 5 end of 5E exist, and there are no legal or regulatory restrictions to the contrary, an institution shall consider as to whether a redetermination of its functional currency and the reporting currency to a stable foreign currency is appropriate in line with relevant phases. In such a case, the institution shall follow the requirements of relevant AOIFI phases. And here we have referred to the hierarchy of accounting policies as per phase 1 and in the requirement of generally accepted accounting principles in line with paragraph 165, which is the hierarchy. Here we had the question from Sister Amal Al-Masri about whether we need to refer to phase 1 or others also. Earlier, AOIFI used to have our own accounting standard for foreign currency translation, phase 16, if I'm not mistaken. Now, what happened that with phase 1, when phase 1 was introduced in 2021, what we did that we believe that some of the standards of AOIFI that were issued earlier were not having that much value addition, and we can stick to IFRS because there were no significant Sharia issues or the business model challenges. And accordingly, at that point of time, we decided that there will be some basic requirements with regard to foreign currency translation in phase 1, which are the core principles with regard to the foreign currency translation, and further details will be referred to IFRS. Our paragraph 165 talks about the hierarchy in which the accounting policies are determined, which include AOIFI financial accounting standards, similar AOIFI financial accounting standards, AOIFI's, then the generally accepted accounting principles, insofar they are in compliance with the Sharia principles and rules as well, in line with the AOIFI framework. So this is the approach by which, in this situation, Sister Amal, you need to apply IFRS 1 and International Accounting Standard 2021 on the foreign currency translation. So I believe now you got answer to your question that this reference in the footnote to paragraph 165 actually means that in your respective country, the generally accepted accounting principles, which in most countries are IFRS, can be followed in the absence of additional guidance from the AOIFI phase. So phase 1 has one a small section with core principles of the foreign currency translation, and then further details as per IFRS. Now, fair value-based financial reporting. So those entities who do not redetermine the foreign currency or are not allowed by the regulator, or in their situation, there is no single stable foreign currency that can serve that purpose, or other factors of foreign foreign currency, stable foreign currency related other factors that are part of the criteria are not present. In all those situations, the institution shall be following the fair value accounting. Now, what will happen that there will be three situations. Some of the assets will be fair value, and when we are saying they will be fair value, they will be fair valued on each period end whenever you do the profit and loss distribution. So the effect of profit and loss distribution is passed on a fair and just basis. That is number one. So fair value. Number two, some of the things are exempt from fair value because of their nature. So we will be mentioning that. So some will be exempt from fair value. And third will be deemed fair value. Now, deemed fair value is that at times fair valuation is not that much easy at all times. So you will be having a deemed fair value concept, which will be like indexed value. But the difference is that this is the basis of application is slightly different in some situations, because it's not just going to be applied like index value, but rather it will be indexing, and then this will become a deemed fair value, and then the other fair value accounting related treatment in line with this standard and other AAOIFI related phases will be applicable. Now, coming to the fair value based accounting, this is the subject of this standard. If you have redetermination of functional currency, then after paragraph 9, this standard stops. Paragraph 10 onwards, we are talking about the entities or the institutions that follow this standard, which is the fair value based accounting for hyperinflation. We have comment from Lamin Savadogo. My apologies if I mispronounce any name, because mashallah, people here join from so many different countries, jurisdictions, and at times we are not familiar with the names or the spelling. So if I mispronounce any name, please, my apologies for that. Thank you, brother. Thank you very much for your kind comment, and Ramadan Mubarak to you and all. Okay, so now coming to statement of financial position. An institution whose functional currency is the currency of hyperinflationary economy shall remeasure items constituting the elements of a statement of financial position at fair value, with the exception of accounting treatments prescribed in paragraph 12-13. Now, what is in 12? The following will be exempt from fair value. Monetary assets and monetary liabilities. Why exempt? Because monetary assets and monetary liabilities are established receivables and payables, which mean that any change to them would tantamount to riba, and that is the reason that Sharia does not allow you to revalue any of your established receivables and payables. Again, even under IFRS, monetary assets and liabilities at the end of the period, at the end of the balance sheet date only, they are not required to be remeasured. But as per IFRS, earlier values, that is at the end of the 11th month, at the end, or on a weekly basis, are still to be adjusted, while as per AAOIFI, these are not to be adjusted at any time because of the Sharia issue. So here we are different from IFRS. Our solution, as I mentioned, this standard, our solution that we have proposed is not very close to IFRS. There is some out of the box thinking in this. Assets acquired for future delivery for which a contract or promise exists requiring delivery sale at a pre-agreed, pre-promised value. So, for example, I acquired asset for Murabaha. So I acquired asset for Murabaha and I acquired it for 100, and I have a promise from my customer available that he will acquire it from me at 120 for a 3 months credit. Now, he will make me payment after 3 months, but because I acquired the asset today and I will be delivering it to my customer, and customer has a pre-promise or a pre-contract in some situations also. In case of, for example, ijara, there might be again for sale, you cannot have a future sale contract. But for salam and istasna, again, you can have a future sale contract. So again, if I acquired goods on salam basis to be sold with a for salam, which are to be sold at a given price at a future date, all those situations where you have a contracted price or a promised price available for some goods or assets which are acquired today, you will not be fair valuing them, because the point is today you fair value and tomorrow when you sell them, the fair value reverses. So there is no point in giving a gain today and making a reversal tomorrow. Held to maturity investments in sukuk and similar instruments reflecting a fixed or virtually fixed stream of cash flow. The investments which are held to maturity in nature in sukuk and similar instruments, they are having a fixed or virtually fixed stream of cash flows coming, which means that even if today I fair value them, tomorrow the fair value will go down and eventually it will go till the end. So if it is held to maturity, that is the reason that held to maturity investments under IFRS and under AAOIFI are normally not required to be fair value. So the exemption of that fair value will still be there to them. But the question is, do we index them then? No. The answer is then we exempt them from this requirement. They will not be even indexed, because the cash flow that is related to them will not be indexed actually. Even if you index it, there will be reversals eventually. So we follow the same accounting treatment that held to maturity investments in sukuk and similar instruments. We understand it well that in hyperinflationary economy, mostly these will not be there at held to maturity for long periods. They might be normally for variable rate instruments. One more thing to mention, if they are variable rate instruments, normally the variable rate will be changing over a period of time. So again, the effect of fair valuation will eventually reverse either way. So in a nutshell, we keep them exempt from the fair valuation. Assets and liabilities linked by agreement subject to Sharia principles and rules to changes in prices, such as through an index with or without caps and floors. So as some Sharia compliant structures may still include some pricing link with the indexes. Again, we are not saying that all of these are halal or all of these are haram. We are saying that if there is a structure which is having a transaction or pricing element linked with the index, which will be adjusting the cash flows that you will be having in future, assuming it is Sharia compliant. We know there are Sharia compliant options in that. So that will also be exempt from the fair value accounting, because it will not be realized at fair value or paid at fair value. Rather, it will be realized or paid at per the indexed value, not at the fair value. Item number E is quasi-equity, which is also exempt. Why quasi-equity is exempt? I'll answer you in the next para. So these exemptions that we have provided in 12 will be subject to the accounting treatment as per 13. Monetary assets, liabilities, held to maturity investments, and assets required for future delivery for which a contract or promise exists requiring delivery sale at pre-agreed pre-promise value to be reported at carrying value in line with the requirements of relevant AAOIFI phases, which means that they will be as per the normal accounting, because normal accounting will be followed for these assets or liabilities. Assets and liabilities linked by agreement subject to Sharia principles and rules to changes in prices, such as through an index with or without caps and floors, reflected at values adjusted in accordance with the agreement. So they will not be at cash, not at fair value. They will be as per this situation. Quasi-equity. Now, the quasi-equity, why we are not asking the quasi-equity to be revalued? Because quasi-equity, subsequent measurement of quasi-equity as per AAOIFI is that quasi-equity you cannot measure directly. Quasi-equity, that is the investment accounts, the unrestricted investment accounts, sukuk based on participative structures, etc. They all have underlying assets. So the valuation of the quasi-equity shall be dependent on the valuation of the underlying asset and not by directly revaluing or readjusting them at fair value or at index value. So if they have monetary assets, monetary liabilities, held to maturity investment, etc. underneath it, what will happen? They will be carried at the same carrying value and the adjustment of profit and loss will be done. If they have assets and liabilities linked by agreement with an index, they will be adjusted. The profits and losses that will be appearing in the pool, investment pool, will be reflected by that. So that will be there. And if there is fair value, because what is not falling in this will be at fair value. So whatever is at fair value, they will all be adjusted. So quasi-equity to be reflecting the appropriate effects of fair value adjustments to the underlying assets and related liabilities where applicable, either through allocated profits or losses or through creation of appropriate reserves. So the normal profit and loss, whatever will be calculated, but additionally this will be calculated. Sister Shariah and Brother Maj, just make a note of it. We will just see that in paragraph C, we need to mention a reference to paragraph B also, because we mentioned about profit and losses that are coming as per fair value adjustment. But do we talk about what is coming as an index-based adjustment as per paragraph B or not? So we might need to not clarify it. Maybe we can just put it in the base of conclusion, but it just came to my mind. So please make it as a note that we need to discuss and check with the working group if they feel it is important to put this effect of B also in C. Now coming to determination and estimation of fair value. Now the question is, I think it's a very difficult time in Ramadan and very difficult standard. For that purpose, I mentioned it several times. So we haven't received too many comments till now. As of now, I don't have any question and answer tab, any comment in the Q&A tab. So my request is to all of you that please try to cover it. And a lighter note, at time I say that if there are no questions, then either all of you are sleeping or otherwise I'm too good. So most of the time I believe that I'm too good. I'm sorry by saying this, but just I'm kidding. But today I can believe that it's not a matter of being too good, it's a matter of people sleeping. So for that, just to bring back your attention, this is a very crucial part of how the fair value will be determined. The items of the statement of financial position of an institution that do not meet the exception criteria specified in paragraph 12, except for the transaction effects as described in paragraph, Brother Maj noted, it should be paragraphs 42 to 44. Okay, Brother Maj, Sister Shariah, it should be plural.
Yes.
Shall include the following: assets and liabilities, if any, that are carried at fair value in line with their respective accounting policies to continue being reported at fair values in line with respective accounting policies, whereby the respective gains and losses to be reported accordingly. Assets and liabilities, if any, that are carried at cost or amortized cost in line with the respective accounting policies to be reported at fair values determined in accordance with this standard, whereby the respective gains and losses on fair valuation to be reported as a part of net in hyperinflationary fair value gain or loss being an item of the other comprehensive income. So what we are saying? We are saying that except for the exclusions in para 12, everything has to be fair value. So now some of the things were being fair valued already, like some sukuk might be fair valued already, like sukuk and other investments at fair value through income statement or fair value through OCI. So some of them were already being fair value. So whatever was already being fair value, it will continue the same way. So their fair valuation will go like this. Now, if there are assets which are not being fair valued earlier, now what happens? Where does their gain or loss goes? So we have said that there will be a separate hyperinflationary fair value gain or loss item in the balance sheet as a part of equity. It will go to OCI, and through OCI it will go to a separate reserve. So it will be routed through OCI to a separate reserve, which means that this will be a net hyperinflationary fair value gain or loss. This is somehow equivalent to the net monetary gain or loss, net monetary position gain or loss in IFRS. But it will be different, not exactly the same, because we have created some exceptions. Dr. Idris, Mohammed Idris has commented that we are not sleeping, sir. Thank you very much, brother Dr. Idris. Thank you very much for being with me here and keeping me awake also. Assets that are carried at lower cost and NRV to be reported at the NRV being an estimate of fair value only in the specific context of the standard, whereby the respective gain on fair valuation to be reported as part of net hyperinflationary fair value gain or loss being an item of the other comprehensive income and the loss to be reported in line with respective accounting policies. So we are saying that for items which are carried at lower of cost and NRV, for them, you can consider NRV as an estimate of fair value. And then the gain will be reported as part of hyperinflationary fair value gain or loss, and the loss to be reported as per respective policy. So if there is a loss, mostly there will not be losses because you can well understand there is hyperinflation. So the value is always going up. So that will be going to the hyperinflationary fair value gain. But in case there is a loss, that loss needs to be booked still as per the current accounting policy. Now, what happens that here we are saying that now NRV and fair value at times can be same. But the difference is that net realizable value, first thing is realizable value versus fair value. Realizable value is the entity specific value, while the fair value is the market specific value. So fair value is the value that I will fetch in the market, that can be fetched in the market by in a transaction between two knowledgeable willing parties in orderly transaction. On the other hand, if I talk about realizable value, this is what I can realize out of it. So my realizable value can be exactly same as fair value, and at times it can be different. Net realizable value, which is normally calculated anyway for inventories and some other situations, net realizable value is realizable value minus cost necessary to make the sale, which means that completion cost and selling cost. So in that situation, we have said that these assets, you do not need to do a separate fair valuation, but rather the net realizable value will be the estimation of fair value. If you get a loss, book that loss according to the normal accounting policy, like a inventory loss situation. And if you have a gain, take that gain to the hyperinflationary fair value gain or loss. Don't take it to the P&L today. Assets that are carried at the revaluation model, revalued amounts less accumulated depreciation and accumulated impairment to be reported at periodically revalued value at least at the end of the financial year. The resulting gain or loss shall be recognized based on the respective accounting policy. We have two comments here. One comment. It seems that there is no way out except what has been suggested, but the question is how the financial statement represents just and fair financial statement. Brother Al-Tijani Ahmed, thank you very much for your nice comment, and thanks that you agree with the approach taken by AAOIFI Accounting Board. Thank you very much for that. But with regard to the fair and just situation, you remember that in the beginning we said that hyperinflation is a situation where the meaningful comparison becomes the comparison becomes meaningless. Meaningful comparison becomes impossible. So the point is here we are trying to create meaningful comparison. Meaningful comparison is important for the financial reporting need of the investors and the other stakeholders. Additionally, brother, you need to keep in mind that we have made these changes to IFRS and not followed IFRS directly because we wanted to make sure that the fairness and justice related requirements applicable to the participating investment account holders, shareholders are also met properly. So if you see the way we have defined the accounting for quasi equity, etc., you will yourself feel that That is the only way of keeping fair and stable, fair and just returns to the investment account holders and the participating investment account holders. Thank you very much, brother.
Brother,
All
I
other
want to raise hand.
Sorry,
Raise hand.
who has raised? You want, okay? So if you want them to be allowed, so who has raised? So brother,
Mr. Ismail.
And brother Ismail Ali, hail, please allow them one by one to speak.
Yeah,
Brother
Mr. Ismail.
Ismail, please.
Mr. Wael.
Brother, while you are permitted to talk now, you can speak now. Brother Wael Mirza?
Brother, no, I didn't. Sorry, by mistake. I raised my hand by mistake. I apologize.
Okay, no problem at all. No problem at all. Maybe it was gesture based. Zoom now takes gestures also. Okay, Brother Ismail, do you have a comment? Anyway, Brother Wael, thank you very much for being with us. It is highly, appreciating for us that senior people like you actually take out time, attend, and it is good that now you are new in our accounting board, so at least you can see how the things move on the accounting side. And surely we would love to have your written comments also in due course. Okay, so let's move ahead. So we are talking about the accounting for statement of financial position. All other assets and liabilities to be reported at deemed fair values, estimated through application of an index in line with the requirements of paragraph 15 and 16. So here is the only place where we allow the indexation. It may be impracticable for an institution to ascertain fair values of certain assets or liabilities due to unavailability of observable data input to assess the fair values of these assets or liabilities, or undue cost and or effort inevitably be incurred in ascertaining fair values. When the condition is described in paragraph 15 apply only in the specific context of the standard, an institution may apply an index to the balances of such assets and liabilities to obtain a deemed fair value. For certain assets and liabilities where applicable, whereby the fair value estimation in line with requirements of paragraph 11 to 14 is performed at the end of the financial year, the requirements of paragraph 15 and 16 for the determination of deemed fair value might still be applicable for the purpose of valuation of such assets or liabilities as of the end of the interim financial reporting period, if the impact within such period is considered material. And obviously, at times it will be material, because what will be happening is that if you are having 30 to 40%, 50% high inflation or more than 100% inflation rate per annum, then even 3 months period, the amounts might be impacted. So what we are saying here is that if you are unable to determine fair values, and for other assets and liabilities where the fair value determination is not possible and those are not part of the exclusion, in all those situations, you can apply the indexed values as deemed fair value. That is number one. Number two, even if you do a fair value accounting at the end of the year, but you did fair value accounting at the end of December 2023, but now in 2024, first quarter financial statements you are preparing, and within first quarter there is a 25% inflation, which means that the impacts might be material. So in that situation, you can apply that index as a deemed fair value. So it was a fair value on which you applied a deemed fair value for a quarter. This way, you can keep the values as current, and this will ensure that the profits and losses and other workings that are done and the rights and responsibilities of the parties reflected are appropriate. Then we have some guidance with regard to selection and usage of index. I would say that this is more or less aligned with IFRS. Today, I just don't want to keep the session very long. So some of the points I will try to skip. Unless somebody has a comment or a question, I'll be happy to address it. But now onwards, because this was the main accounting that we already discussed. But for the remaining sections of the standard, I will try to be quick, because although we have half hour left, but our preference is to close, not take 2 hours of your time today. So we'll try to keep it quick. So in a nutshell, this is some criteria for the selection and use of an index, that how the index can be used. There is one thing that we have included specifically is an index based on a basket or a basket of stable foreign currencies. So that is one of the things that we believe the approach is slightly different from IFRS here as well, if I remember correctly. But this is where we believe that at times you can have a more appropriate way of it, and at times it is more reliable data. The problem is that in a lot of countries, the data of index against foreign currency or a basket of foreign currencies is more easy and reliable, while the data with regard to the index of consumer price or the wholesale price or all the indexes based on the market price data, at times they are not that much reliable. So in that situation, an index based on a stable foreign currency might be much more reliable because all data is more easily available. Selection and use of an index, again, there is additional requirement with regard to provision of FAS 30 with regard. Just one thing, Brother Masht and Sister Noof, if you just note it down, that this FAS 30 requirement should be after a separate heading. So I think there should be a heading in between. There should be a heading after paragraph 20 about the application of the impairment and credit losses, etc. Yeah, because it looks like that this para is a part of the main accounting treatment for a statement of financial position, but it's not part of the subheading related to selection and use of an index. Okay, so it should be appearing either with a heading, or maybe we can take it. Maybe we can take it above the selection and use of an index. We'll see where to place it, or otherwise it's better to just put a. We can put a simply put a heading above that, level 3 heading. Okay, now coming to statement of income and other comprehensive income. So we are saying they are not to be restated. This is different from IFRS. The IFRS requires you to restate the periodic balances. Now, why we are saying it will not be restated? Because we are saying that we are asking you to do a fair value accounting, which means that monthly you are doing a fair value accounting, quarterly you are doing a fair value or deemed fair value accounting, which means that the profits and losses related to those periods are already included in the statement of income and statement of other comprehensive income. And they are already distributed to the respective parties or kept to the reserves related to respective parties. One thing, let me clarify. And this is a very important challenge that we discuss time and again, and I think I did not discuss it earlier, but let me discuss it. So for example, there is a 100% gain this year. If we try to distribute that 100% gain, that 100% gain might not be available in form of cash. We cannot distribute it to the shareholders. We cannot distribute it to the investment account holders because that is invested in asset to asset and asset to asset. So now, this is a possibility that according to AAOIFI's current standards, investment account holders related reserves may be maintained even in case of a fair value reserve. So the same accounting treatment is to be kept here, that a hyperinflation fair value reserve and the normal fair value reserves for these investment accounts will be kept. There are some disclosure requirements related to that. I'll come to that. Because even if there are some reserves, these reserves will be reversed over a period of time, and once these are reversed, this amount should be paid to the investment account holders, participating stakeholders, and shareholders. Again, it's up to you whether you pay or you don't pay. But for investment account holders and participating stakeholders, it's a must that it should be paid. So from that perspective, it should be paid when it is recycled to income statement again. And those which are not recycled, again, so the distribution is as per Shariah and contractual requirement. Distribution is not as per accounting. So there is a gain. We are not asking you as an accounting to distribute that gain. We are asking you that you recognize that gain, you record that gain to whom this is attributing, and then you make disclosures to the investment account holders that there are gains related to them. So if they go out today, they will lose those gains. And those who will continue in the entity, with the institution, with their investment account, over a period of time when these gains will be reversed to income statement, and those amounts will be in cash, and the cash will be available, those will be distributed. So the fair value gains will be distributed on recycling basis again, but this is according to the contractual and Sharia requirements, not the accounting requirements. Accounting requirements tell you to how to record the gain and where to put the gain, but it does not push you to pay the gain. Payment of gain is a Sharia and contractual issue. The net gains or losses for the period arising through the application of paragraph 11 shall be recognized in the statement of other comprehensive income. The resulting item shall either be subsequently accumulated as distinct hyperinflationary fair value reserve, categorized and presented separately, representing the owner's equity and the quasi equity separately, and presented as allocated profit or loss, distributable or non-distributable in case of profit. This is again or either. The standard does not require any adjustment to the statement of income and distribution related to quasi equity, except for reflecting the appropriate effects of fair value adjustments according to the respective para. The effect of such adjustment shall either be accounted for through allocation of profit or creation of appropriate reserves, including where applicable hyperinflationary fair value reserve in line with the respective accounting policies. The statement of cash flow is not required to be restated or adjusted. Consolidated financial statements. In a nutshell, what we are saying that if you are a parent, you should be if your currency is a currency of hyperinflationary economy, you may have a conventional currency being a currency of a hyperinflationary economy. So first situation is where you are hyperinflationary and subsidiary is hyperinflationary. Second situation is you are not hyperinflationary and subsidiary is hyperinflationary. The financial statement of subsidiary will be restated according to this situation. I think this point I explained in the beginning as well. I can see a question now. Sister Amal has made the point with regard to quasi equity. I think we have to apply the principle of isolation separation with complete precision when forming a fair value reserve to isolate the underlying asset financed by depositor fund from the bank's other assets while applying this standard. Sister Amal, this is a good point. Actually, the banks, even in normal banks, we suggest always that the account, the fixed assets and other long-term assets should not be part of the investment pool attributable to the investment account holders. For example, even the investment in subsidiary, etc., should also not be based on that. So this is our general view. However, there might be situations which might be impacting these situations. So this is a challenging situation, but your point I fully agree. But this is an accounting standard. Sister Amal, how in an accounting standard we can say that you isolate this? This isolation can be a Sharia requirement, a governance requirement, or a regulatory requirement. But this isolation cannot be an accounting requirement. Accounting requirement would be how to reflect it. But thank you very much. I fully agree and endorse your comment is very good. The financial statement of subsidiary that has functional currency not being the currencies of hyperinflationary economy are dealt with in accordance with the requirements of respective AAOIFI. When financial statements with different periods and are consolidated, this standard shall apply to all balances at the date of consolidated financial statement. Restatement of investing institution. An investee that is accounted for and that the equity method may have functional currency being the currency of hyperinflationary economy. The statement of financial position and statement of comprehensive income of such an investee are restated in accordance with this standard in order to calculate the investor's share of its net assets and profit or loss. When the restated financial statements of the investee are expressed in foreign currency that are translated, so in a foreign currency, they are translated at closing rate. Brother Maj, just make a note of it. After foreign currency, there should be a comma, and normally instead of they, we write these. Okay. Or we should say, or either we say these or such financial statements.
Noted.
But it should be a comma because I just felt like there is something missing. If you put a comma after foreign currency, it will be better reading. Without comma, we are okay, but if we put a comma, it will be better reading. Economy ceasing to be hyperinflationary. When an economy ceases to be hyperinflationary, an institution discontinues the preparation and presentation of financial statement prepared in accordance with the standard, shall treat the amount reported in line with the requirement of the standard at the end of the previous reporting period, financial reporting period, as the basis for carrying amount in its subsequent financial statement. So that becomes the carrying value, and going forward, you apply the normal AAOIFI phases. But as of that date, your values are adjusted. Just one more thing on the presentation side, very important presentation side. In addition, what we are asking in the comparatives. So IFRS asks you to adjust the comparatives. We are asking you that financial statements will be presented in a way that they will be presented in a way. Let me just take that part first. So there will be two type of figures. Number one is corresponding figures. An institution shall present the corresponding figures for its financial statements the same as previously reported, except for any restatements in line with the relevant requirements of phase 1. So corresponding figures, because corresponding figures as per Sharia cannot be changed, you have already made those changes, you have distributed, you have monetary values that cannot be adjusted. So accordingly, you will be not adjusting those values. And there will be a third column comparative, which will be based on index. So this will be a full financial statements adjust the third column based on index. So what we are asking is, there will be normal corresponding figures, which were based on whatever was reported last time. There will be a third column, which will be including indexed comparative, which will be just for making a comparison purpose, but it will not be the actual corresponding reported figures. Now, on the presentation side, the more important thing, there are some general disclosure about functional currency being a hyperinflationary currency, and that fair value has been applied, the basis of accounting that have been applied, the identity and level of price index that has been applied, amount of hyperinflationary gain or loss for the period related to quasi-equity and related to owner's equity, amount of accumulated hyperinflationary reserve related to quasi-equity and owner's equity. Then you have the net fair value gain or loss disclosed according to the paragraph 31D2D1 shall be classified between that are distributable and non-distributable, because some of them can be distributed and cannot be distributed. Similarly, about recyclable and non-recyclable, that how much of it will be recycled to the statement of income, which means it will be distributed, and how much is distributable within 12 months, that is recyclable within 12 months. So whatever is recyclable within 12 months will be available to the investment account holders for distribution within next period. So this is again one of the important aspects. Then the balance that is not expected to be recycled to the statement of income, that also need to be mentioned. Then whatever is related to quasi-equity and the disclosure of expected period of reversal should be identified. So any quasi-equity holder who leaves the institution and takes out his investment should be aware that he is leaving a balance that will be reversed over a period of time, and on over what period it will be reversing. And the institution shall disclose plan about utilization, the balance of hyperinflationary fair value reserve that is not expected to be recycled or to a statement of income. Then accounting policies, new and amended accounting policies are to be disclosed. Corresponding figures we discussed already. Index comparatives, I mentioned that they will be according to the today's picture comparatively, changing the comparatives as exactly as through the index. You're applying that day's index and today's index. I'm not going into detail about this thing. Effective date is proposed to be January 2026, 1 January 2026. And there is one more thing, that it is preferable that all institutions in one country or one jurisdiction should follow it from the same date, so that the results are comparable between institutions. And then there are some transitional provisions. We don't need to go in detail for that. I have one comment from Sister Amal. I suggest to add the paragraph rationale for issuing the standard presenting the financial statement of AAOIFI in a more fair and equitable manner with regard to compliance with regulations of the supervisory authority, because of what when AAOIFI present the financial statement in local currency appear to be exceeding the precautionary ratios that is specified by the supervisory authorities, while It is not. Thank you very much, Sister Amal. It's a very good comment. We'll take it to the working group and we'll see whether how we incorporate it. I personally have no objection on that. We'll try to incorporate it, inshallah. We have comment from Brother Ali Asghar Mandassarwala. In paragraph 17, as regards interim reporting, the indexation to be applied is only for the interim period based on the previous year-end fair value. Paragraph 17, just let me just go back to paragraph 17 just to recheck in which context you are talking. Okay, deemed fair value. Yes, agreed. Thank you, brother. Agreed. 17 will apply, like if you see, even if you see this part, 17, you need to see 17 with the. Okay, yeah, 17 is on interim periods. Exactly. So it will be applicable on all, as well as it will be applicable additionally for the fair value that was determined on annual basis, but on quarter basis, fair value is not determined. So deemed fair value will be determined. So the year-end balance as of comparative was based on what level of index. You will adjust it with this current level of index. Thank you very much, Brother Ali Asghar. Very good question. I hope I am able to clarify it that yes, your understanding is correct. Okay, do we have any other comments? I cannot see any other comment, but we are just completing. I think we have 15 minutes left to time, but our plan was to complete it a bit earlier. So I hope we are generally okay on time, but we can quickly take a couple of more comments if there are any. If there are no more comments, then we can conclude. I still can't see any comments. So Sister Hora and Brother Maj, back to you for conclusion, please. And from my side, Assalamu alaikum to everybody and Ramadan Kareem, and
Thank you. Thank you very much, Brother Omar. Jazakallah khairan. Thank you very much for the invaluable session on hyperinflation. We would like also to thank all the participants for their valuable comments and being around for this couple of 2 hours in Ramadan timing. Inshallah, we look forward for having further public hearings on the same standard. Hopefully, we will have two in Arabic, two in English and one in Arabic, inshallah, very soon. Thank you very much. Jazakumullahu khairan. Assalamu alaikum wa rahmatullah. Assalamu alaikum.